The selection of the 10 equities analyzed in this report followed a multi-stage screening process. First, the forward dividend yield was required to exceed 5%, based on current market prices. Second, the companies had to demonstrate a minimum 3-year history of maintaining or increasing dividends, with a preference for those showing long-term streaks or aristocrat status. Finally, sustainability was assessed through the lens of payout ratios, interest coverage, and free cash flow yields.
Selected high-yield equities performance metrics. TotalEnergies, 5.27% forward yield, 64% payout ratio. Sanofi, 5.01% forward yield, 75% payout ratio. AXA, 5.52% forward yield, 65% payout ratio. BNP Paribas, 5.79% forward yield, 50% payout ratio. Crédit Agricole, 6.20% forward yield, 52% payout ratio. Rubis, 5.71% forward yield, 56% payout ratio. Klépierre, 5.54% forward yield, 76% payout ratio. Carrefour, 5.93% forward yield, 74% payout ratio. SCR, 6.12% forward yield, 60% payout ratio. Mercialys, 6.65% forward yield, 79% payout ratio.
TotalEnergies remains a cornerstone of the French dividend landscape, offering a blend of traditional energy cash flows and a transition into integrated power markets. As of February 2026, the company's forward yield is approximately 5.27%. Operational mechanism and dividend growth. The company utilizes a quarterly dividend distribution model, which provides consistent liquidity to shareholders. For the 2025 fiscal year, TotalEnergies distributed €3.28 per share, representing a 7.19% increase from the previous year. Looking ahead to 2026, the board has proposed a final dividend that would bring the annual total to approximately €3.40 to €3.47 per share. This growth is not merely a byproduct of higher oil prices. It is increasingly driven by the firm's expansion into liquefied natural gas, LNG, and renewable power. Strategic moves such as the full restart of activities in Mozambique LNG and the acquisition of wind and solar portfolios in Greece and Portugal have diversified the revenue stream away from pure-play crude oil volatility.
Dividend safety and balance sheet. The safety of the TotalEnergies dividend is reinforced by its conservative payout ratio of 64% and an exceptionally strong cash financial position. At the end of 2025, the firm maintained a debt-adjusted cash flow that allows it to fund its dividend and capital expenditures while concurrently executing an aggressive share buyback program. The company's normalized gearing and its ability to maintain a high ROACE, return on average capital employed, suggests that even in a lower-price energy environment, the floor for the dividend is well protected. Furthermore, its exposure to AI-driven power demand in Europe offers a structural growth tailwind that traditional oil majors lack. TotalEnergies dividend payout history. 2024 full-year total, €3.06, plus 6.99% growth. 2025 full-year total, €3.28, plus 7.19% growth. 2026 projected total, €3.47, plus 3.66% growth.
Sanofi is often regarded as the premier dividend aristocrat of the CAC 40. In January 2026, the board of directors proposed a dividend of €4.12 per share, marking the company's 31st consecutive year of dividend growth. This record is unparalleled in the French market and underscores a corporate culture that prioritizes shareholder income through all phases of the pharmaceutical R&D cycle. The Opella divestment and value unlock. A critical component of Sanofi's 2026 outlook is the potential divestment of its consumer healthcare unit, Opella, valued at approximately €15 billion. This strategic pivot is intended to streamline the company into a high-margin specialty care leader focused on immunology and rare diseases. The success of Dupixent remains the primary engine of Sanofi's cash flow, but the expansion of its pipeline into areas like Stage 3 Type 1 diabetes and RSV vaccines provides the necessary growth bridge to sustain the dividend as older patents expire.
Safety metrics and cash flow coverage. While Sanofi's earnings-based payout ratio can appear elevated, reaching 104.7% in 2024 due to significant non-cash impairments of intangible assets, the underlying cash flow tells a more secure story. The company typically retains about 69% of its operational cash flow,
ensuring that even after paying a 5% yield, there is ample capital for research, acquisitions, and the maintenance of a strong credit rating. For 2026, analysts anticipate a 5.27% increase in the dividend, a growth rate that exceeds the pharmaceutical industry average and is well supported by the firm's robust dividend sustainability score. AXA is a global leader in insurance and asset management, currently offering a forward yield of 5.52%. The stock has become a favorite for Eurozone investors seeking beta exposure to the financial sector, but with the defensive characteristics of a diversified insurer.
The sale in 2025 of AXA Investment Managers, AXA-IM, to BNP Paribas allowed AXA to exit a complex, capital-intensive business and refocus on its core insurance competencies. To offset the resulting earnings dilution, AXA executed a €3.8 billion share repurchase agreement, which effectively supports the EPS and, by extension, the company's ability to raise the dividend per share. This mechanism of buyback-supported dividend growth is a hallmark of AXA's strategy to deliver a 6% to 8% CAGR in underlying earnings per share through 2026. Financial strength and solvency. Dividend safety at AXA is monitored via its Solvency II coverage ratio, which stood at an impressive 202% in mid-2025. This is twice the level that would trigger mandatory coupon deferrals, providing a massive buffer for equity payouts. The company's interest coverage is high at 17.08x, and its total debt-to-equity ratio remains manageable at 116% for a financial institution of its scale. The dividend payout ratio is maintained at 65%, a level that balances competitive yield with capital retention for organic growth in key markets like Italy, where it recently acquired Prima Acciaierini to bolster its direct insurance presence.
AXA Dividend Safety Metrics. Solvency II ratio, 202%, well above regulatory minimal. Interest coverage, 17.08x. 3-year dividend CAGR, 11.82%. High growth for the insurance sector. Buyback yield, 2.6% to 5.1%. BNP Paribas. As the largest bank in the Eurozone, BNP Paribas has leveraged its scale to become a dominant high-yield play, with a current dividend yield exceeding 5.7%. The bank's ability to sustain such a high yield is a direct result of its diversified business model, which encompasses retail banking, investment banking, and now a massive global asset management arm. Consolidation of AXA IM and non-interest income. The acquisition of AXA IM has created an asset management organization with €1.6 trillion in assets under management as of September 2025. This integration is a turning point for the bank's investment and protection services division, providing a stable source of fee-based income that is less sensitive to the ECB's interest rate decisions than traditional lending. Management has committed to delivering a 12% return on tangible equity in 2026, a target that serves as a fundamental floor for the dividend policy.
Capital discipline and payout safety. BNP Paribas maintains a 50% payout ratio, which is among the most prudent in the European banking sector. This policy allows the bank to retain half of its annual profits to build its Common Equity Tier 1 capital, providing a safety net against economic downturns. In 2025, the bank demonstrated its capital strength by announcing an equity buyback of over €1 billion in addition to its generous semi-annual dividend payments. With a dividend cover of approximately 3.5x, the probability of a dividend cut is considered low, even in a stressed macroeconomic scenario. Crédit Agricole, often referred to as the Green Bank due to its deep roots in agricultural and cooperative banking, offers one of the most stable high yields in the French market at 6.2%. Its unique structure, consisting of local and regional banks, provides a highly resilient deposit base that fuels its public-facing entity, Crédit Agricole SA. Dividend policy and growth targets. The bank has set an ambitious dividend growth target of 8.5%, aiming to increase its payout from $1.10 per share in 2025 to a projected $1.22 by the end of 2026. This growth is supported by solid profit trajectories in its commercial and personal banking divisions in France and Italy, which are expected to contribute significantly to the bank's return on tangible equity over the 2026-2028 period.
Safety and refinancing advantages. Crédit Agricole's dividend safety is underpinned by its superior access to funding. The bank is a leader in the covered bond market, where it anticipates 10% growth in issuance for 2026. This technical advantage allows it to refinance its operations at lower costs than many peers, preserving the margins necessary to sustain high payouts. Furthermore, S&P Global's BBB Plus rating on its subordinated notes, 2 notches below its A issuer credit rating, reflects a high level of confidence in the bank's capital structure and its ability to service both its debt and its equity holders. The payout ratio remains highly sustainable at 52%. Rubis operates in the niche but essential sector of energy distribution and bulk liquid storage. With a forward yield of 5.71% and a 27-year history of paying dividends, it is a quintessential hidden gem for French income investors. Marketing margins and dividend resilience. Unlike major oil producers upstream, Rubis' profitability is driven by marketing margins and distribution fees in regions like Africa, the Caribbean, and Europe. This model is inherently less sensitive to the spot price of crude oil, as the company can pass through cost changes to consumers. This structural stability has enabled Rubis to achieve a 3-year average dividend growth rate of 15.58%. The 2025 dividend of €2.03 per share was well covered by earnings per share of €3.63, resulting in a healthy payout ratio of 56%.
Safety through asset monetization. The company has recently engaged in strategic asset sales, such as the disposal of its 55% stake in Rubis Terminal to I² Capital. This move has significantly strengthened the balance sheet and provided the liquidity necessary to reinvest in higher growth segments, such as its bitumen business and renewable energy initiatives. Analyst consensus for 2026 remains positive, with expectations that the dividend will continue its upward trajectory toward $2.13 per share, yielding approximately 6% at current valuations. Klépierre is a leading real estate investment trust with an exclusive focus on high-traffic shopping centers in continental Europe. For income seekers, its status as an SIIC, Société d'Investissement Immobilier Coté, means that it is legally mandated to distribute the majority of its rental income, currently resulting in a 5.54% yield. Klépierre has successfully navigated the challenge of e-commerce by curating a retailer mix focused on fashion, beauty, health, and leisure. In 2025, the company achieved a rental uplift of 4.6% on renewals and relettings, while maintaining an occupancy rate of 97.1%. This operational momentum translated into a 5% increase in net current cash flow to $2.72 per share, which provides a robust cushion for its $1.85 to $1.90 dividend. Credit quality and dividend longevity. A primary concern for REIT dividends is the cost of debt. Klépierre maintains an industry-leading credit profile with A/A ratings from S&P and Fitch. The company recently raised €1 billion in new financing at a highly competitive blended yield of 3.3% with an average maturity of 8.5 years. Its historically low net debt to EBITDA ratio of 6.7x, LTV ratio at 34.7%, and an interest coverage ratio, ICR, of 7.2x make its dividend one of the safest in the European real estate sector. Furthermore, its low occupancy cost ratio of 12.5% suggests there is still room to increase rents and therefore dividends in the coming years. Carrefour, grocery retailer, has undergone a transformation under its Carrefour 2026 strategic plan. It currently offers a forward yield of 5.93% and is increasingly recognized by analysts at firms like Kepler Cheuvreux as a top pick for 2026. The company is trading at a nearly 50% discount to its European peers, a valuation gap that management is closing through divestments and operational streamlining. The disposal of its Italian operations and the successful refinancing of its Brazilian subsidiary are expected to lead to a 15% upward revision in consensus EPS for 2026. This earnings growth is the primary driver of Carrefour's recent dividend increases, including the 17.95% 3-year average growth rate.
Cash flow versus earnings payout. While Carrefour's payout ratio relative to GAAP earnings can appear high, over 180% in some periods due to non-cash impairments, its cash payout ratio is far more reassuring. The company retains approximately 27% of its cash flow after all dividend obligations are met, providing the liquidity needed for store renovations and its burgeoning digital retail media business. As the grocer shifts toward higher-margin private label products, the stability and sustainability of its 6% yield are expected to strengthen further. SCR is a global Tier 1 reinsurer that has successfully emerged from a period of sector-wide volatility. In 2026, it offers a yield of 6.12%. The hard market and underwriting profitability. The reinsurance industry is currently benefiting from a hard market, characterized by significantly higher pricing and more restrictive terms and conditions for primary insurers. This environment has allowed SCOR to return to robust profitability, with Q3 2025 EPS reaching €1.22, a sharp turnaround from losses in the previous year. The company's focus on high-quality underwriting and the management of its contractual service margin under IFRS 17 has increased the transparency and predictability of the earnings that fund its dividend.
Payout stability and risk management. The dividend is currently well covered with a payout ratio of approximately 60%. While reinsurance payouts can be volatile due to natural catastrophes, SCOR's diversified global footprint and its sophisticated use of alternative capital, such as catastrophe bonds, mitigate these risks. For 2026, analysts anticipate a steady or increasing dividend, supported by a 1.4% growth rate and the company's commitment to a sustainable shareholder return policy. Mercialys specializes in the ownership of shopping centers anchored by large grocery retailers. This essential retail focus has made its 6.65% yield one of the most reliable in the French REIT sector. Net recurring earnings and footfall growth. In 2025, Mercialys reported a 3.9% increase in net recurring earnings to €1.26 per share, comfortably exceeding its proposed dividend of €1. The company's portfolio value rose by 10.1% year-over-year, driven by the revaluation of the St. Genis II Center and a footfall growth rate that was 300 basis points above the national panel. This outperformance demonstrates the resilience of grocery-anchored physical retail in the face of broader economic shifts. Sustainability and leverage. Mercialys maintains an EBITDA margin of 82.4% and an LTV ratio that improved to 39.5% in late 2025. The company's objective of maintaining a dividend of at least €1 per share appears achievable, given that its NRE guidance for 2026 is set at a minimum of €1.29 per share. The positive yield spread of over 300 basis points compared to the 10-year OAT provides a significant margin of safety for investors.